Hi, I'm Jimmy. In this video, we're going to walk through a quick review of where the US economy stands after the Fed cut interest rates. We're going to use various economic indicators to see if we think that a recession is coming in the near future, and in theory, if the stock market's going to crash. Or do we think that the economy will keep rolling forward and therefore it makes more sense to invest our money right now? This is the S&P 500 going back 2 years. And the first thing that jumps out at me is how volatile it's been. 2 years ago, there was a jump of more than 20%, and then that was followed quickly by a pullback of about 10%, and then it rallied another 15% over the next 6 months or so, followed again by a decline of almost 20%. It was about 19% at that time. Then it rallied for about 30% more. Now, we're also ignoring this part of the chart right there. Now, if we clear all of this away, what we can see in the past few days, well, the stock market has pulled back once again. So our question is, do we think that this is the start of a buying opportunity, or are we better off just sitting on the sideline and waiting for the recession to come? We know that a recession will eventually come, although we don't know when. So do we wait for a recession to actually happen, or is this just a buying opportunity and we should jump in right now? Well, the Fed just cut interest rates, so clearly they're seeing some signs of weakness. And I figure that we can look at some of the same things outside of the market volatility and see if we can determine, if we can gather our own independent opinion of where we think things will go. And then hopefully that will help us make more informed investment decisions. Okay, so there are some leading economic indicators that generally do a good job of predicting where the economy is going. One of those leading economic indicators is housing. Now, in the last video we did that was similar to this, we looked at housing starts, and we ranked it as neutral since it looked like this. And it looked like it had been trending higher for a while, and then it looked like it sort of settled off a bit. But either way, it wasn't negative, so we just called it a neutral reading. Housing starts, by the way, are how many new houses are being built. Okay, simple enough. But the Fed, when they made their decision to lower rates, came out and said that housing was a potential drag on the economy right now. So when we switch to the average housing price, well, here we could see that housing prices have been growing at a slower pace over the past year or so. So that being said, I can understand why this is a concern for the Federal Reserve. So if we jump over to our handy scorecard here, well, here I think it makes sense to give this point to the bears. Last time we had it as a neutral one, but now I think it's more of a negative sign than anything else. Okay, now let's shift over to manufacturing. And the last time we did this analysis, we actually gave manufacturing a negative mark since this is what the chart looked like. So as we could see, it's been trending negative recently, or it's been trending lower recently, so it gets a negative mark. Easy enough. But if we update that with the new numbers, well, we can see that things have only gotten worse. So once again, I understand the Fed's concern, and they specifically cited manufacturing as being an issue. So the fact that this is lower could be a problem for the economy. And just so we're all on the same page, this economic indicator tracks the production levels from the manufacturing sector month to month. So better manufacturing, in theory, we have a stronger economy. Now, if we're wondering how to read this chart or how to read this indicator, basically, the key level on this whole chart is 50. So if this indicator came in exactly at 50, well, that would imply that there would be no growth in manufacturing. No positive growth, no negative growth, 50 is flat. So anything above 50 implies positive growth in the manufacturing sector. Anything below 50 would imply negative growth, broadly speaking. So what we're looking at now, well, we're looking at a gradually reducing growth level, which is right in line with what the Fed cited as the problem. They cited that there was still growth, but it was slowing, so they're looking to kick things off a little by lowering interest rates. So clearly, it makes sense to give manufacturing a negative score on our handy-dandy scorecard here. Okay, now we slide over to consumer confidence. Well, there's not too much to say about consumer confidence. Consumer confidence looks pretty good. It's pretty high. It's been up here for a while. I think this makes a lot of sense to keep this as a positive. And if we're curious if consumer confidence is actually a good indicator, well, consumer confidence is one of those leading economic indicators that tend to do a very good job of predicting where the economy would go, and something that they suggest most investors should pay attention to. To illustrate, when we go back to the Great Recession, well, here, the orange line is the S&P 500, and the blue bars are consumer confidence. So as we can see, consumer confidence started to head lower before the stock market hit its high, before the market began to tank from the Great Recession. So clearly, consumer confidence means something. Now, if we switch back to today's chart, we can see that there's no early signs that there's any weakness with consumer confidence. So I think it makes sense for us to give the bulls a point on our handy dandy scorecard. Okay, so now we have 2 points for the bears and 1 point for the bull. Now, typically, I've been including unemployment in this type of analysis, but unemployment is actually doing decent. We know that if you've watched any of our other videos, we've talked about that in the past, but I'm going to leave it off this time because technically unemployment is a lagging economic indicator, even though I think it does a good job of indicating the level of strength of the economy. The Fed went out of their way to say that they were ignoring unemployment or they were worried about the economy despite unemployment looking fairly good. So I think it makes sense for us to skip it at this time and we'll just stick with our same 2-to-1 score right now. Okay, now we move on to the very important yield curve. Now, I actually think that this played a huge role in the Fed's decision to cut interest rates. See, the Fed controls short-term rates, super short-term rates, specifically overnight rates. That's what the Fed funds rate ultimately is. It's the rate that banks can borrow from the Fed or ultimately each other on an overnight basis. So the theory with the yield curve is that it should be upward sloping. So if you're going to borrow money at a 2-year rate, well, that should be a higher rate than if you were looking at a 3-month rate. And this should remain true all the way down the line. The further you go out, the higher the interest rate should be. Now, they call this yield curve an inverted yield curve because right now the 3-month rate is higher than the 10-year rate. Now, this tends to be a bad sign for the economy since recessions are generally, almost always, preceded by an inverted yield curve. So once the yield curve inverts, that could lead to a recession. And as of right now, the yield curve is inverted and it's been inverted for a while. Also, another indicator along the same lines with the inverted yield curve, the 3-month to the 10-year, is the 2-year to the 10-year. This one's still positive right now, but it's getting closer to being inverted. This could be a problem for the Fed and for the economy at the end of the day. So this is most of the information that the Fed cited when they made their decision to lower interest rates. So I think we probably have enough information to start making some decisions. Now the question is, do we invest now or do we wait, or do we think it's smarter to wait for a crash to happen and then come into the market? Clearly, things with the US economy are looking pretty negative right now, and it's completely understandable. After all, we've had a 10-year bull run. Look at the S&P 500 over the past 10 years. So it's understandable if we're a bit worried about the market crashing at this point. We all know a stock market crash is going to happen. We can say that with absolute certainty. The tougher part, if not the impossible part, is to say when it's going to happen. Now, personally, I'm a big fan of staying invested almost all the time, unless the money we're investing we need in the short term. Because up until this point, every recession the US has ever had has been shorter than the subsequent bull market. So assuming that history is a decent predictor of the future, well, if we stay invested and if we were to invest today and the market were to crash tomorrow, it's likely that we'll make our money back in the not too distant future. But on the flip side of that coin, if the crash doesn't come for 2 years or 3 years or 5 years, well, now the Fed is cutting interest rates. What if that crash doesn't come for a while? They're cutting interest rates. They stopped selling off the assets on their balance sheet. So it's possible that they continue to push the economy forward. So for me, I think it makes sense to stay invested and not wait for the market to crash in order to be invested. But this is going to vary depending on each of our personal investing goals and our investing situations. So there's an old saying on Wall Street that says, don't fight the Fed. And basically what it means is that if the Fed is lowering interest rates, a bull market is likely to follow. And since that's exactly what the Fed is doing right now, they might just have enough power, enough sway to keep this bull market running a bit longer, as crazy as it seems. But what do you think? Do you think it makes sense to stay invested, or should we head for the hills and wait for the market to crash? Please let me know what you think in the comments below. Personally, I think it still makes sense to stay defensive with our portfolios, but do you agree? Let me know what you think in the comments, and if you haven't done so yet, please hit the subscribe button, hit the thumbs up. Thank you so much for sticking with me all the way to the end of the video, and I'll see you in the next video.